$5 trillion gone, gold and silver tumbling. The financial headlines are screaming panic, and if you're holding precious metals or equities, yesterday may have felt like the end of the world. But let's pause, take a breath, and look carefully at what really happened. Because what appeared to be a free fall was not the collapse that the mainstream media would have you believe. It wasn't the end of the bull market. It wasn't a signal that gold is broken or that silver is doomed. What unfolded in the last 48 hours was a perfect storm of forced liquidation, cross-asset margin calls, and a mechanical cascade amplified by a lack of liquidity. To anyone who panicked, it felt like the sky was falling. But for those who stayed calm, understood the mechanics, and watched the evidence, it was a reminder of one of the oldest truths in financial markets. Chaos can be temporary, fundamentals endure, and liquidity-driven panic creates opportunity. Let's start with the scale. $5 trillion erased across equities, commodities, and crypto markets is not a figure that can be brushed aside. That's not noise. That's not hyperbole. That is a systemic tremor that reverberates across portfolios, hedge funds, pensions, and retirement accounts worldwide. And yet, while the headlines were focused on the losses, few reporters dug into the cause. They didn't report on the structural mechanics behind the drop. They didn't connect the dots between tech equity crashes, hedge fund leverage, and the sudden $500 intraday swings in gold. So let's do that now, piece by piece. The day began with the opening of the NASDAQ. Microsoft, one of the heaviest weighted tech giants, opened down 7%, and by the close, it had plunged nearly 12%. That single company erased over $350 billion in market capitalization in one trading session, the second largest single-day loss in history. That alone would rattle markets. But when you consider the interconnectedness of hedge funds and cross-asset exposure, the implications are enormous. Many hedge funds were highly leveraged in tech equities, holding massive long positions in Microsoft, cloud infrastructure stocks, and software giants that had been inflating in value for months. When the tech positions collapsed, margin calls were triggered instantly. These funds had to post additional collateral to maintain positions or face automatic liquidation. That's when the dominoes started falling, and here's the key point. The dominoes weren't just in equities. The forced liquidation spread across asset classes to the most liquid instruments available. That means gold, silver, and even Bitcoin became the collateral of choice for scrambling hedge funds. They weren't selling because fundamentals changed. They were selling because their brokers demanded cash immediately. That is critical to understand because the $500 crash in gold in 30 minutes was not a rejection of gold's value. It was an ATM moment for leveraged traders. Now, let's look at the timeline. By mid-morning, gold, which had been hovering near $5,590 in Asia and early European trading, plummeted nearly $500 in half an hour, bottoming near $5,100. Silver followed the same pattern, moving from highs above 121 to lows near 107. For anyone watching the charts, this looked catastrophic, but the speed and magnitude of the move point directly to a liquidity vacuum. This isn't normal market selling. This isn't ordinary retail panic. This is what happens when market makers step aside. When banks that provide quotes and absorb risk in futures markets widen bid-ask spreads and shrink their position sizes, the market becomes a free-falling elevator. Stop-loss orders cascade, automatic selling accelerates, and the price gaps open wider and wider because there are simply no willing buyers in the moment. The banks and bullion dealers weren't just cautious. They were constrained by regulatory capital rules, by Basel III restrictions, and by the extraordinary volatility that had already driven the relative strength index in gold to overbought territory. With everyone retreating from risk, the market created an air pocket and the price dropped into it, purely mechanically. The psychology of fear was amplified by the mechanics, and retail investors, looking at charts for the first time, thought the end had arrived. But the story didn't end there, and this is where understanding the mechanics becomes your advantage. As fast as gold and silver fell, they recovered nearly as quickly. By the afternoon, gold had bounced back to $5,379, silver to $115, recovering much of the day's losses. This V-shaped recovery is classic forced liquidation behavior. The people who sold at $5,100 were not the long-term buyers. They were the leveraged sellers covering margin calls. On the other side of the trade, physical buyers and informed institutional investors saw the panic as an opportunity. India and China, which had seen physical demand cool slightly in prior weeks due to high prices, surged back in, paying premiums over spot. ETFs in North America reported inflows of $334 million, confirming that real buying activity was absorbing the liquidation wave. The fundamentals remained intact. Nothing had changed regarding central bank purchases, geopolitical tensions, or U.S. fiscal exposure. If this had been a real crash driven by demand collapse, we would not have bounced back within hours. We would still be testing lower levels, exploring uncharted territory. Instead, what we witnessed was a temporary disruption, engineered in part by structural mechanics, in part by panic psychology, but one that ultimately failed to shake the foundations. The mechanics are important to understand because they will shape your actions going forward. Hedge funds and leveraged tech investors triggered the initial shock. Exchanges, having raised margins globally in response to volatility, unintentionally amplified the effect. When CME increased gold and silver margin requirements and Shanghai adjusted theirs multiple times in a 10-day span, it made it exponentially more expensive to hold long positions. That alone forced liquidations. Combine that with market maker withdrawal, compressed liquidity, and cascading stop-loss triggers, and you have a recipe for a sharp, short-term drop. But crucially, these forces are temporary. They are not long-term shifts in supply and demand. The underlying market structure, the demand from physical buyers, the ETF accumulation, and the continued central bank purchases remains unchanged. In fact, the panic selling created a rare re-entry opportunity for those who missed the January rally from $4,300 to $5,600. Buying at $5,100 or $107 per ounce of silver was effectively a discount relative to the fundamentals. Meanwhile, broader market signals reinforced the view that this was a liquidity-driven event rather than a systemic collapse. The U.S. dollar remains weak, hovering near four-year lows, and real yields continue to be negative, providing ongoing support for precious metals. Geopolitical risk has not abated. Tensions in Iran and Ukraine persist. Fiscal concerns remain acute, with U.S. debt surpassing $38 trillion and Japanese bond yields hitting 30-year highs. These factors will continue to underpin gold and silver as safe haven assets. Analysts from Deutsche Bank, Goldman Sachs, and independent observers like Ross Norman have all reaffirmed that the medium-term outlook remains bullish. Yesterday's panic did not alter that thesis. In fact, by compressing prices temporarily, it provided a clearer signal to long-term investors where genuine value lies. We also need to consider the psychology of the retail investor. Many saw gold drop $500 and thought the bull market was over. Many saw silver fall to $107 and panicked. But those who held, those who recognized that this was forced selling rather than demand collapse, now own positions at prices that are fundamentally attractive. Market manipulators, if their intention was to shake out long-term holders, failed spectacularly. The physical buyers in Shanghai, Hong Kong, and India, along with ETF investors in North America, demonstrated that liquidity-driven panic does not necessarily equate to real weakness. The trap failed, and those who stayed disciplined were rewarded. This is a critical lesson in market behavior. Volatility can be engineered, but the underlying fundamentals, physical demand, central bank activity, and geopolitical risk cannot be manufactured as easily. Looking ahead, there are catalysts that could accelerate gold and silver's move higher. The U.S. government shutdown deadline looms, with probabilities spiking above 75% according to multiple models. Historically, shutdowns drive investors towards safe haven assets, reinforcing the demand thesis for precious metals. Any further deterioration in U.S.-China relations, new geopolitical tensions, or continued weakness in tech equities could trigger additional cross-asset flows into gold and silver. The infrastructure of the market itself, with futures in backwardation and strong institutional limit orders, now supports a scenario where dips are bought aggressively, creating upward pressure. The Fed remains constrained, the dollar is politically and economically pressured, and central banks are continuing to accumulate. All of these factors set the stage for a continuation of the bull market in precious metals, despite the temporary chaos that investors witnessed. So for those watching from the sidelines or holding through the storm, what lessons emerge? First, understand the difference between mechanical selling and demand collapse. The two are very different, and they require different responses. Second, recognize that forced liquidation events are temporary, and V-shaped recoveries are possible when fundamentals remain intact. Third, monitor liquidity signals, margin requirements, and cross-asset exposure to understand potential short-term volatility. Fourth, focus on physical and institutional buying activity, because these are the participants who shape real price trends over time. And finally, maintain perspective. $5 trillion may sound enormous, but markets have absorbed far larger shocks without collapsing. Volatility is not the same as failure. In conclusion, what we witnessed in gold and silver yesterday was not the end of the bull market, nor was it evidence that America is heading toward a financial collapse. It was a forced liquidation triggered by margin calls cascading from tech equities into the most liquid assets available. The crash was amplified by rising margin requirements, withdrawn liquidity from market makers, and stop-loss cascades that created temporary chaos. But the fundamentals, the safe haven demand, central bank accumulation, dollar weakness, geopolitical tension, and fiscal instability remain intact. The physical and institutional buyers stepped in at discounted levels, absorbing the liquidation wave and ensuring the market quickly recovered. This episode demonstrates both the dangers of high-leverage speculation and the resilience of assets underpinned by strong fundamentals. Investors who understood the mechanics and stayed disciplined were rewarded. Those who panicked were shaken out temporarily, but will likely be able to re-enter at advantageous levels. The evidence shows that gold and silver are not collapsing. They are consolidating, shaking off excess speculation, and preparing for further gains. The crash was a mechanical event, not a signal of financial collapse, and the market has proven remarkably resilient in the face of $5 trillion in simultaneous paper losses. For anyone watching, the message is clear. Fundamentals matter, liquidity events are temporary, and the opportunity often lies in moments of engineered panic rather than in the headlines of fear.